the company that we are talking about today is AFRM. This is actually one of those fintechs that have been fairly popular, at least on FinTweet. And then people, I mean, personally, when I've been investing in SOFi over the last couple of years, this was one of those companies that I actually compared SOFi with because I never understood why, especially in the last year, that they could remain unprofitable while trading at a higher multiple than SOFi. So I tend to bash them quite a bit when I talk about SOFi. I mean, not intentionally and not because I don't like the company. I do think they are a pretty good company, as you'll see later today. But yeah, I think let's start with understanding that with AFRM, I would like to say that their business model is fairly straightforward. They operate as this digital payment network that connects consumers with merchants. Okay, so let's get into the business proper. AFRM's core business basically revolves around providing transparent, interest-bearing and interest-free installment loans at the point of sales. And they do this both online and in the point of sale transactions in store. So, like for the benefit of those of you who are pretty new to their business, I did some digging in their 10K to give you a little bit more details about their business. To give you a little bit more details about the business. So we'll be looking at some metrics later on that we can use to judge how their business is growing. Now, basically, what AFRM does is that they help the consumer by increasing your purchasing power. They tell the consumer that they give you more control and flexibility, which is true. And they have a unique way of underwriting using various machine learnings, algorithms, and proprietary data that they actually from the users that puts them in a position where they can serve a large variety of customers across the credit spectrum and accurately price in the risk involved, right? So if you, on the merchant side, I think what they actually tell the merchants is that, if you use a firm can actually help all these merchants drive growth by enhancing demand generation and customer acquisition. So there's this one part in the 10K which I don't really understand. They say that the point of differentiation for AFRM is that they can accommodate and partner merchants to serve their payment needs across a wide variety of industry sizes, average order volume, as well as customer profile. Now, I'm not sure whether I agree that this itself is a differentiation. I'm pretty sure companies like Stripe and PayPal can also do the same thing. I think the main thing that we need to understand about a firm's business, right, is that to start understanding their business, you have to look at their gross merchandise volume, right? This is how much people spend on their platform. And basically, the entire makeup of this is basically 3 loan product offerings that they have. This makes out the bulk of their GMV. They have the Pay in 4, which is the 4 bi-weekly payments of 0% APR. They also have this spread 0% APR installment interest-bearing 0% APR installment payments. And of course, the bulk of it comes from their interest-bearing loan. So if you take a look at the product mix across the past year, you can see that between 70 to 75%. Now, the most recent quarter, which is this graph that you're seeing over here, came in at 72%. But over the past year, it's been hovering around 70 to 75% of their GMV comes from interest-bearing installments. And then it's a fairly even split of around 13 to 15% between Pay in X as well as 0% APR. So what does this mean for so what this means, I guess, is that from the consumers itself, a firm actually earns interest income on all these interest-bearing installment loans that they originate. Now, the interest on the loan does depend on various factors such as the transaction risk, the credit worthiness of the consumer, and as well as the repayment term, as well as the principal amount. So a firm also does that because consumers are not charged any deferred or compounding interest or late fees. Hence, they're actually not incentivized to profit from consumers making mistakes or misfortunes, right? Unlike the banks. So on the merchant side, how a firm actually makes money is that they earn a fee when they help merchants convert a sale and facilitate the transaction. This is actually fairly straightforward. The thing is that there isn't a fixed fee over here. The fees are negotiated with the merchants, and I think that depends on the products that they are offering, the amount, the average order volume, and things like that. And I think generally the guideline is that a firm earns a larger merchant fee, especially if they do offer the 0% APR product. So I think what they also do is that a firm also facilitates this virtual cards that they launch, I think in early 2021 or 2022, directly to consumers through their app. Now this this card, I believe, was launched quite a while back, but only gained traction in the last couple of years, and it allows consumers to shop with the merchants that are not integrated with Affirm, right? So these merchants are charged an interchange fee for every successful transaction, and the portion of this revenue will then be, of course, they will share their cut with their issuing partners. But I think there are a couple of ways apart from what we have covered about how Affirm actually generates their revenue, things like their gain on loan sales and servicing revenue and things like that. But I'll break that down for you when we cover the valuation of a firm, right? So this is just by and large understanding how they make money, right? They allow the consumer to pay in a certain number of time, and within a certain period, they give you 0% APR. Beyond that, you need to pay interest on whatever amount that you take out as a loan, and then they make interest on that loan. That's how they make money from the consumer, and then from the merchant side, they basically get a fee as well, right? As well as interchange fees from cards. So that's basically generally how they make money. Yes, I have a valuation for a firm right at the end. So I think for me to understand a firm's business, apart from understanding the gross merchandise volume, we also have to look at the active customers, which is this second bar that you're seeing over here, as well as the transaction counts or active transactions per active members. So later again, these are two metrics that we will be following very closely throughout our valuation of a firm. And I have to say that, the number of members added is a lot more lumpy compared to companies like SOFi. But of course, we also have to acknowledge that SOFi has, only around 12 million members, which is about half of what a firm has, right? So all these active members on their platform are transacting, and you can see that basically the repeat transactions from this group of active customers make up around 94% of their overall transactions every quarter. 6% of the transactions then comes in from first-time users. Now, ultimately, Affirm is a payments platform, and because of the nature of their business, when you look at the numbers, I think you will start to notice some cyclicality in their yearly revenue. But by and large, right, like I was showing you with Oscar and all that previously, the metrics are basically up and to the right, despite the cyclical nature. You're just going to see the pattern repeat, but at a higher level. And so this is, like I said, the easy way for us to track this and to know that this is on track is basically to follow the increasing revenue generated per customer. And all of these will be covered in more detail when we are looking at the valuation at the end. So Affirm has really been a stock that has been volatile over the last couple of years. And I think it's important as investors to know whether or not the management is capable of taking the company through this volatile period. And I guess we need to start with, understanding who is the guy in charge, which is this gentleman that you're seeing on your screen, Max Levchin. Now, everywhere I read, people tell me, oh, he's a great CEO. I'll be very honest and say that, previously, before looking at Affirm, I think I first started looking at Affirm back in 2023. I wasn't too familiar with him. I think it's probably my own ignorance because, being from Singapore, some of his appointments, some of his companies have been more geared towards US and Europe, right? I know he founded PayPal in 1998, but if you have followed some of my PayPal videos previously, I've already said that, PayPal actually isn't that big in Singapore because we have our own payment system. Now, he was CTO at PayPal until its $1.5 billion acquisition by eBay, again, another company that is not used heavily in Singapore. And then later, he founded Slide, which was acquired by Google, and HVF. And basically, it's a lab that birthed Affirm in 2012. So he was on Yelp's board of directors between 2005 to 2015 and served on Yahoo's board as well between 2012 to 2015. But because, since I was old enough to actually understand what was happening around the internet, I was already using Google and I barely used Yahoo, perhaps in the early 2000s when I was back in elementary, primary school. But overall, if you ask me, he really has a pretty impressive CV. And as I take you through the last couple of years, you can actually see that I think he's very honest. He's very candid with shareholders. He's willing to admit his mistakes. And you can see that he acts very quickly on some of these mistakes to turn the company around. And that's what I really, really like about him. And so over the last couple of years, Affirm had to deal with fairly high interest rates, and it has put pressure on their buy now, pay later margin. And so in 2022, you can actually see this was this was actually extracted from their shareholder letter. You can see that the stock price went down over 60% year to date, trading in over $100 in 2021, down all the way to $50. Now, if you look at this particular paragraph in their shareholder letter, this was towards the end of 2022, you can see that Affirm basically admitted to an operational misstep with pricing. So they were late in increasing their prices while rates were rising. And the prices here are basically referring to the merchant fees and the APR that consumers are being charged for their loans. And because they were slow to adjust these numbers relative to the macro environment, so their revenue and their gross merchandise volume took a hit. Now, this was because as they raised these prices, they started to tighten their underwriting process. This basically became a increased cost to merchants, and basically that slowed down growth as well. And so to make it worse, actually in 2022, Apple also introduced their version of Apple Pay Later. Now, of course, later on, Apple discontinued that and allowed some of these platforms like Affirm to basically be on Apple Pay. But during that point of time, that was when Apple was trying out launching the Apple Pay Later. And basically, this was one of those things that got people, the sentiment towards Affirm started to be a little bit more negative, and that's why people actually sold off the stock in 2022. And basically, it was a slow grind all the way down from the teens to the $8 range towards the end, at the middle of the end of the year. Then when we get to the early part of 2023, where are we? Yeah. Then when we get to the early part of 2023, later on, you're going to see in one particular quarter, revenue growth actually came in at around 7.9%, just a single digit year-over-year growth. And I believe that, and you can see over here, 9th of February 2023, this is the time where they actually cut a large part of their staff, right? So basically over here, what you notice is that they cut around 19% of its workforce, and it's largely due to, basically not making the numbers during their most recent earnings call. And on top of that, you can also see that over the last couple of quarters, going into 2024, because of the rising interest rates, their average cost of funds rise, which was basically what they were alluding to earlier. But I think despite all of these things, despite all the fears around the increased funding costs, as well as that this increased funding cost acts basically as a headwinds for their revenue, they have shown signs of recovery since that early 2023 period, albeit the recovery is slightly lumpy, right, compared to what I would have liked to see. Now, basically, since then, they have announced an expansion of their partnerships with companies like with companies like Amazon, as well as, I think at that point in time was Best Buy, right? Amazon and Best Buy. Now, at the same time, once they announced that, a couple of months later, you can see this was in April of 2024, Walmart basically launched the Fintech One, right? Which basically says, Walmart-backed Fintech. They didn't launch the Fintech. Walmart-backed Fintech One launches their own buy now, pay later services. Now, this was back in April of 2024. This is not to be confused with Walmart leaving Affirm as their partner earlier on in this year. That was in 2025. But last year, right, Walmart basically reported launching their own buy now, pay later using this platform called One. But I found this story regarding Walmart quite confusing because, yes, 1 year ago, they were trying to launch their own buy now, pay later platform. But 1 year later, in early 2025, they left Affirm's ecosystem to join Klarna instead. So I'm not too sure what to read into that. Is that thing Affirm that it's not as Klarna? And yeah, I'm guessing that it did this buy now pay later didn't work out for Walmart. So it also shows at the same time it's not easy to build your own buy now pay later for companies, and so that's why companies, if they want to offer this buy now pay later option, tends to have to use companies like Affirm or like Klarna. So this happened in the early part of 2024. You also had concerns over rising credit losses due to all the inflationary and recessionary fears. And I guess it is a lot of these macro news that that overshadowed some of their fundamental performance. And that was when you can see fundamentally they were starting to change to turn the business around compared to what they were doing. Now, of course, they also got a boost in September of 2024 when basically Affirm got confirmed that they were being added onto Apple Pay, right? You look at the fundamentals, like I said, beyond all these news about partnership with Amazon, Walmart leaving their platform, then them getting onto Apple Pay and things like that. I think if you just purely look at the fundamentals, they have been accelerating their GMV growth. Let me show you this. Between December 2022, this was actually when they put out the announcement of them having some operational missteps. Now you can see the following quarter, March of 2023, This was when they actually grew revenue by 7%. That's when they had to cut their staff. Now, the GMV at that point in time only grew by 17% year over year. Now, since then, you had the announcement of going into 2024, you had the announcement of their partnership with Walmart. That happened in the end of 2023. Going into, I realized there's a labeling mistake here. Going into 2024, you had Walmart, trying to launch their own buy now, pay later. At the same time, you also have Apple announcing that Affirm is now part of, they allow Affirm to basically operate on Apple Pay. But all the while, if you look at the numbers from that 17%, you can look at the growth rates over here. They have slowly built back the company, which is why I said those things that I covered, partnership with Amazon, losing Walmart onto Apple, these are the narratives around the company. But if you look at the fundamentals of the company, they have basically tried to turn the ship around over the last couple of quarters and then eventually coming to where we are in June of 2025, right? So this is something that we have to bear in mind when we are looking at this company. There are a lot of different narratives around the company generally that basically cause the stock to be highly volatile. But if we focus on the fundamentals, over the last couple of quarters, fundamentals have been trending in the right direction. As you can see, I think if you take a look at the earnings in the most recent quarter, I think one of the things that I want to point out before talking about their earnings is that during their earnings, you're going to see this acronym called RLTC. I'm going to point it out to you later. This actually represents revenue less transaction cost, and that is the number that a firm pays the most attention to. It's not just revenue, but revenue less the transaction cost. So we're going to see how this has performed. But if you take a look at the breakdown of their revenue over here, like I was saying, they have this merchant network revenue making up a big part of their overall revenue. This comes from all the merchant fees. And then the second one comes from their card network revenue. Like I was saying, they run their own Affirm card. So this is the total network revenue. And then on top of that, they have interest income. This comes from the consumer. And then, of course, they have gain on loan sales, basically reported over here, as well as servicing income when they actually service small parts of the loan, right? Which means that they manage the loans, including the collections, as well as the customer support. And so all these make up a smaller part of other revenue, but you can see that the bulk of the revenue comes from merchant network revenue, as well as the network income, where they collect interest payments on the loan offered out. So this is the most important metric to understand a firm, which is revenue less transaction costs at RLTC. This grew 53% year over year to 353 million in Q3 of 2025. Now, a firm has a slightly weird reporting schedule where they report their earnings. I think their fourth quarter is ends in June of every year, right? So Q4 2025 will be reported in as June, which is second quarter of 2025, right? And I think it just so happens that I didn't plan this, but their earnings are basically going to be reported end of market day today, right? So we'll basically we'll talk about that at the start of tomorrow's stream. Like I said, if you want to understand a firm, this is the most important metric you have to understand. It's grown 53% year over year, and this revenue, less of transaction cost, as a percentage of overall GMV increased by 45 basis points to 4.1%. Now, this has slightly exceeded our long-term target range of 3 to 4, which means the revenue at less transaction cost should be around 3 to 4% of their total gross merchandise volume. But with how effective they have been in cost cutting, they have been able to drive this up to 4.1%, and we hope to see this actually continue in the quarters ahead, right? So this has really shown you the ability of management to control their costs. Like I was saying, management admitted their mistakes in 2022, and despite all the narratives, all the noise around the company, partnerships that they have formed, partnerships that they have lost, being onto Apple Pay, being threatened by Apple Pay initially, they have executed through all of that noise. They have turned the company around on a fundamental basis. And right now, what you're seeing is that they are having very strong cost controls coming into the end of 2025, because this is the first year that they actually hope to turn up profitable. And then from there on, hopefully in 2026 and onwards, they can continue to grow that profitability. So if you are looking throughout the business, I think all the other metrics seem to really be performing very well over here. You can see gross merchandise volume is up 36% year over year. This was down sequentially from Q2 of 2025. Now, but like I said, you have to bear in mind Q2 of 2025 is actually December of 2024. And that is the holiday season where spending tends to go up. And that's why there's some cyclicality to their revenue. So revenue came in at $783 million. This was up 36% year over year. And I think the last quarter was that means Q3 of 2025. That was the first quarter that they barely became profitable. Now, I could be wrong. Later we will check. But I'm pretty sure that this was the first quarter that they become barely profitable. Just $3 million in net income. And to me, it is not just the headline numbers that look good. When you understand the company, you have to look beyond the headline numbers. And you can see their strong cost control over here. What you're noticing is that R&D, sales and marketing, as well as G&A, all of them, the yellow lines in particular, are trending down. Now, what this yellow line represents is that that is the total amount being spent as a percentage of overall revenue. And so if I break this down by each individual segment, you can see that in their R&D, their tech and data analytics segment, the cost, the absolute cost, which is represented by the blue bars, came down, and now it's re-accelerating. So they are reinvesting back into more R&D. Now, despite doing so, you can see the yellow line has still been trending down. Recently inflected upwards slightly, but I would say it's trending down perhaps even on a percentage basis compared to revenue. Sales and marketing, you can see that this has a huge drop-off, both in terms of a percentage-wise compared to revenue, as well as the absolute number. And G&A, this shows very consistent cost control, where they have more or less maintained general and administrative costs at this level in terms of cost. But you can see as revenue grows and cost remains the same, the cost as a percentage of revenue has fallen down. So this really demonstrates good operating leverage, and that is why I really like this company on a fundamental basis. But I think the large part of their business has to do with the loans that they give out. I haven't really looked too much in detail with their loans, and so I could be nitpicking because the only comparison I have in my mind is like SOFi. I know SOFi's numbers. And I think SOFi's numbers actually look better. Not to say these are bad numbers, but I think SOFi is slightly better. So if you take a look over here, you can see that they are tracking their various loan vintages, and they seem, which are all the colored lines, and they seem to fall within the historical range. However, if I do want to be very picky, I want to point out that the dark blue line that you are seeing, especially in the top graph, that shows Q4 of 2024 seem to be tracking slightly above earlier vintages. Now, I'm not too sure if when this actually plays out, whether or not it's going to have an effect on their profitability in future, but that is something that we need to watch out for. Now, in terms of delinquency performance in the full year of 2025, you can also see, which is the darker green line over here, it is trending above their 2020, 2022, 23, as well as 2024 rates, right? So to me, again, this is not a business where I can definitely say for sure that there is no risk even during recessions because of delinquencies. They have more or less kept it within a certain range, but they're not always getting better. Like with SOFi, you can see that every single loan vintage that they have offered since they have come onto the market have always performed better than the previous loan vintages. That is not really the case for a firm. They tend to be a little bit more volatile in their underwriting, and that could also be down to the fact that a firm serves a wider range of customer. So this is a risk that you have to price into the system. But I think apart from that, earlier on in the year, they have also announced an extension. I think this happened just in August, and they have extended their agreement with Shopify. Is it August? Maybe not. I think August was something else. Was like Stripe and things like that. This particular paragraph was taken from also their shareholder letter in the Q3 of 2025. Now, basically, they announced an extension of their partnership with Shopify, launched the beta of their Canadian collaboration, and announced that UK will be next, right? So they basically plan to expand outside the US. Now, on top of that, they also announced an expansion of their relationship with Adyen, which is also a payment provider. And basically, that's going to make integrating a firm within the UK a lot quicker because Adyen is a company that is based in the UK. Now, I think what is most important for a company that charges all these merchant fees and things like that is that they tell us that their dollar-based net expansion continues to hover in the 115% range. I think ideally we want this to be at 120% and above, but renewal rates are high. 97% renewal for merchants with trailing 12 months revenue of 1 million. sorry, not revenue, with trailing 12 months GMV of $1 million or higher. So I think you can see over here that people like Affirm. And at the same time, I also think that, in terms of this particular product, there's not many other choices that are doing it better than Affirm. I think comparable, yes. Perhaps companies like Klarna could be comparable. Not too sure about Sezzle. I haven't really heard about them before. At least I know Klarna because I've been to Australia a couple of times recently, so I do know that they operate from there. But I think apart from that, the people don't really have much choice, and at the same time, I think Affirm offers a pretty competitive product out there. Affirm is going to be announcing their Q4 2025 earnings. This is the outlook that they have given us. They expect revenue to come in around $815 to $845 million, with transaction costs around $430 to $445 million, right? So this RLTC should come in between $385 and $400 million, and then with 344 million shares outstanding. Now, why is this important? Because you have to remember this number later on when we are going to use their numbers for our estimation in our valuation. Okay, so you see, basically analysts in general are expecting them to bring in around 12 cents of EPS out of revenue of $837 million. So this 12 cents of EPS will help us to basically estimate their net revenue later on, and I'll do the math for you as we go through the valuation. Okay, so this is basically the number of active customers on Affirm's platform, and I think what you're seeing is that the total active customers has been growing quite steadily. The number of customers added has been this is not the customers added. This graph, this is the one with active customers, and then you can see the net new additions over here, fairly lumpy, dropped for a while, that has increased, but then last quarter that came down again, right? But I think the number of members that are being added onto their platform, while important, is not the key metric for them. It doesn't matter how many members that they have, but I think it's more important that the members spend on their platform. Now, if you think about it, they only have around 20 million members on their platform with over 200 million people in the US. I would say that they still have space to expand in the US, so I'm not too worried about that. But in terms of total customer count, like I said, I plotted this against the revenue generated per customer, and you can see both has been increasing in the same direction. Now, what you're seeing over here is basically the transaction mix over here between the repeat transactions as well as first-time transactions. So you can see there is a little bit of lumpiness when it comes to the transactions, right? There's always a bump over here as you get into December, another bump, but each time this pattern happens, it's getting higher and higher. So I wouldn't have any problems or any worry about the cyclicality, because it is a standard pattern that we can track, and you can see that it is increasing. But what is important is that you can see, the large part of this over here, which is the blue bars, this is made up of repeat customers, right? And it's only this small component over here. These are first-time transactions on their platform. And I think this basically is more or less in line with the number of customers that are being added every single quarter. Now, if you look at it on a quarterly basis, you can see one particular quarter. This was the quarter over here. If I scroll up, you can see in March of 2023. Oh, I believe this is too small, sorry. Yeah, in March of 2023, right? So you can see this was what I was talking about earlier. In this particular quarter, this was the quarter where they released around 19% of their workforce. But then since then, they have grown their revenues pretty steadily over the next couple of quarters and recovered from there. So this is represented by this dip that you see over here, and then their growth rates basically recovered from there. And I think now they're evening out in the 30% range, right? So that's very healthy. Now, operating income, you can see they were highly unprofitable for a long period of time, which is why I never understood why the market priced them at a higher price to sales compared to a company like SOFi. That is something I would never understand, but I think the market is always right. And then I think, people get humbled in the market, right? You can think that you're right, investing in fundamentally sound companies, but if the markets don't agree with you, then the markets don't agree with you. Okay, they finally turned profitable in the last couple of quarters, and they're expecting to do so again in the next quarter, which is basically tomorrow. Now, free cash flow is plotted here. You can see it's fairly inconsistent. Some quarters they have free cash flow positive, like here. Some they are not. But I think you have to understand that at the same time, they have a large part of their business where it is where they're dealing with loans, they are moving loans on and off their balance sheet. And so because of that, that affects the free cash flow. And so later on, I'm not actually using a DCF to value a firm. I'll be just valuing them through the multiple approach. I need to explain a couple of things. The first thing is that I've used $3.178 billion as an estimation for their revenue. Why? Because they tell us that revenue should come in between 3.1 to 3.3 something. So this is basically the midpoint of their guidance, which represents a 37% year-over-year growth. Okay, I think that is fairly healthy. In the hyper growth phase, as we would call it, you can see 2023, this was the year that it was quite hard for them. But I think later on, I'm not going to penalize them for that because they were growing fast beforehand and they have since managed to recover. So, like I said, not going to penalize them for that. This is where I need to take you through a little bit of math to see how I get to this $24.2 million. Now, earlier on, I told you remember reading that analysts basically tell you that EPS will come in at 12 cents. Management has told us that they will have around 144 million shares. If you take 12 million, if you take 12 cents, you multiply it by 344 million, 0.12 times 344. You get around $41.2 million of net income. Now, if you take a look at their results in Q3 of 2025, you would realize that on a last 9 months, right, across the last 9 months, their net income is still negative $17 million. I believe it's 17. Yeah, around negative 17 point something. Let me take a look. I'll verify it right in front of you. So this can be checked in their 10Q. Okay, net income last quarter. Oops, this is not a highlighter, forgot. Net income last quarter came in at $2.8 million. But I just want you to I'm just going to circle this number and then I'm going to zoom it out. But even if you account for that, you can see on last 9 months, 31st March 2025, net income was negative $17.05 million, right? So this is important because if I already am holding on to a $17 million loss and I make $41 million, from here, I need to minus away this $17.5 million loss that I already have, which ends up getting you to this number of $24.24 million. So that is what I expect a firm's net income to come in as tomorrow, right? With this number of shares outstanding, this is the EPS. Now, from here, because they just turned profitable, that is why I find these kind of valuation processes very hard to do and very hard to use as a reliable way to gauge a company's price, because you can literally use anything you want to put in any number and you can justify whatever stock price you want. So with that being said, I'm just going to use single-digit growth over the next couple of years, single-digit margins over the next couple of years, all the way until 2028. And I think that's more than conservative enough for a company like a firm. If you look at how SOFi are doing it, they hit profitability. Next year, profitability really ramps up. I don't think it will be 3%, but let's just assume that it is. Even if it is, in 2027 at 80 times PE. Why 80 times PE? Because that is what companies like SOFi and Robinhood were trading at when they just became profitable, and the street was giving them, I think, relative to their earnings, right, is 80 times for a company that just became profitable. That's fine. By 2027, 2 years time, they should be around 99 cents of profitability. That is assuming number of shares outstanding really only gets diluted by 4% over the next couple of years. In fact, that might be a little bit low, because if you look at it historically, dilution has been more than that. Now, I won't go back too far. Even if I look at the last couple of years, 4.8, 4.9, and then 11% this year. And then what is their margins over here? These are the two things that are going to be playing a factor into the valuation of the company, which to me, I feel quite hard to project out right now. Maybe because I haven't dug into every single transcript. Like when I research SOFi, I literally read through every single transcript, but I haven't done that for a firm. I didn't have the time. It's only 3 weeks that I had to prepare. I only read through the last maybe 2 to 3 quarters. And I think perhaps with today's earnings, could perhaps have guidance from management. So with that being said, I think if we do get guidance tomorrow from management, I keep saying tomorrow because it's tomorrow my time. If we get guidance from management at the end of the day today, then perhaps we'll fit that into this model. And then at the start of tomorrow's stream, before we look at Duolingo, we will redo this valuation again. So with that, they should be worth at around 78 cents. 80 times PE, you got to bear in mind. That's relative. That's fairly high for me. Price to sales, I used 9 for the simple reason is right now that they are trading at around 10. Historically, they have traded a little bit higher, but as the revenues grow, as they become a more mature company, I'm not too sure how high this will go. I don't think it's conservative enough to use like even what they were doing at previously, around 18, 20 times, unless they really put up very, very strong growth from here. So with that, you can using sales, the price target should be 126 bucks. Price to earnings around $78, $79. You put this together, this turns out to be an implied price of $102.94. Now, for me, I'm giving this a 15% margin of safety. Why am I giving it a 15% margin of safety? Well, because they have made mistakes before, right? I'm not saying that companies like SOFi and all that haven't made mistakes, but I mean, their mistakes was operational mistakes. It's not image or branding kind of mistakes, but mistakes that really led to operationally basically resetting the company for one entire year. Even if I don't count that, highly sensitive to rates, which means that if they fail to raise their fees high enough, they're going to be basically taking it in the margins, right? They're highly sensitive to rates. What was the other thing? Oh, delinquencies higher than what I'm comfortable with. If you are comfortable with their delinquencies, this may not be a problem for you. Then you can give them a lower margin of safety. But for me, worried about that. So with that, because they're highly sensitive to rates, their delinquencies are higher than what I'm comfortable with. It's always within a ballpark, but there's no consistency in how with their delinquencies. And then I need to see a proof that this actually works through a recession, not a technical recession that we had, a real recession. Not that I'm hoping that we get a recession, but I'm just saying that we need to wait until they actually get through one recession, how these underwriting and these delinquencies actually play out. Then I'll be more safe with the company. So with that, AFRM barely makes it into the story-driven category, which is more or less where I would say it is. If I can actually score them a little bit more accurately on their balance sheet and cash flow, they may go a little bit higher. But I think at $80 today, it represents a little bit too much risk for my liking, because it assumes basically strong execution all the way through into the future. But with all the job reports coming out, with a lot of uncertainty over whether or not we're getting to a recession, whether or not inflation will persist, nobody knows. I think that for a similar business, there are better options out there right now, even at this price. And so with that, I think I'll bring the stream today to a close, and then I'll see you tomorrow for Duolingo.